Welcome to the program. Welcome, Alan Gassman and Jonathan Blattmachr. So we're some number of weeks since the enactment of OBBA. We've all seen and done innumerable webinars going through the basics of OBBA and what OBBA did, and lots of articles about, sort of a survey of OBBA, which is great. But now we're trying to dig in further, deeper into planning. Alan, let me just start with you, and then I know Jonathan is going to talk about 6080, but what are some of the issues? We're all grappling with planning post-OBBA. Some general comments on where we are, and let's assume everyone's kind of read the basics already and knows what the provisions are. We don't have to go through that.
Well, we find that a lot of our best clients no longer have federal estate tax as their primary challenge. So it's time to regroup and think about creditor protection, family protection, and what to do with all these trusts and all these installment sales and all these voting and non-voting membership interest arrangements that we've put together, and maybe how we can save them some income taxes. So it's really changed the game board quite a bit.
Don't you also think, one quick comment, Jonathan, and then I'll flip it to you, and this is to either of you, some of the wealthy clients may have a much reduced income tax given the incredible depreciation, R&D, and other write-offs. I haven't heard it yet, but I would not be surprised to find that some clients, when we start trying to shift to income tax discussions, they're going to say, well, my forecasts are that I'm not really paying any tax or much tax. Thoughts, comments?
But Marty, you're talking about not paying estate tax.
No, income. With the 199A enhanced deductions, QOZs, once they kick in, the R&D deduction, the bonus depreciation, there's some very powerful income tax breaks.
Right, but I don't think for most of our clients that's going to be an issue. I mean,
Okay.
Remember that that's really applicable to people who have closely held businesses.
Correct, but I think there's going to be some number of clients that will surprise us by saying, I don't have a high income tax.
Well, that could be, Marty. I think
I just think we need to keep that on the radar, because the massive income tax breaks for certain categories of taxpayers will help reduce taxes. I know, Alan, I agree with you. I think it is reassessing everything. And one of the things that I find concerning, complicated in that process is if we now want to say, hey, we're not subject to estate tax, do we undo the discount planning where we can? Do we try to get assets back in the estate for basis step up for those that are not subject to estate tax? And that's something like, I think the statistic is that only 0.2 or 0.25%, depending which you read, of families will have an estate tax. So it's pretty, it may be a material part of advisors' businesses, but it's a pretty immaterial part of the population. And most advisors, the bulk of their clients, are not going to be subject to estate tax. But what worries me is what comes down in the next administration or the administration after that. So, one of the challenges, and maybe we should defer this and first talk about 6080, because I know Jonathan wanted to talk about that, is do you undo stuff, and how do you, if not undo it, get it in the on deck circle to undo it until we see how things play out? I'd be concerned if we undo planning and then find that, whether it's the next election or the election after, we're facing a very different environment. Jonathan, one of the things that I know you wanted to talk about, and we can come back to some of these other issues with Alan after, is Code Section 6080 and what it might mean to trust taxation. And I know Ladd Boyle, who's a co-author with you on a trust income tax book, I believe he was one of the first, or the first guy to pick up on this. And I'm not sure a lot of people have really focused on it. So maybe you can explain it and give some background before you delve in. And Alan, I know you had some interesting thoughts on it as well.
Well, Section 68 basically provides that once you get over a certain threshold, your itemized deductions get cut back. And that's been in the law for quite a while, but Section 68E said this section does not apply to non-grantor trusts and decedents estates. So it just didn't apply at all. But there are a myriad of deductions, itemized deductions, that would be hit by this. And what happened in the new act is that they said that the section 68E exception, which said this section shall not apply to non-grantor trusts and decedent's estate, is now gone, which implies that the rule does apply to decedent's estates and non-grantor trusts. And that means that if you are taking an income tax charitable deduction under section 642C, it's going to be cut back. And the way it works is that section 68 basically says you lose about 5.5% of your itemized deductions once you get over the threshold where for you as a taxpayer, the top 37% income tax bracket kicks in. Now, for a married person, that's about $750,000. But for an estate or a non-grantor trust, it's only about $15,600. So if you have a trust or an estate that's trying to take a charitable deduction, maybe you have, for example, a charitable lead trust, and you thought, well, what we're going to do is we're going to have a charitable lead trust, and that will mean that we'll get a deduction for the income we pay to charity under section 642C. Section 642C is what estates and trusts look for instead of section 170 to take their income tax charitable deduction. And it can be used, it's very powerful in some cases. For example, if you have a charitable lead trust, but now you hit that position where you're going to start having your deduction cut back at just $15,600 of income, which is not very high, especially if the family was intending to create a large income tax charitable lead trust. Now, during lifetime, almost always people will create their charitable lead trusts, which provide basically for annuity payments for someone's life or for a period of years. And they'll do that in order to take a gift tax deduction for the value of what is committed to charity. And the numbers are such that you can basically say, hey, everything in this trust is going to go to charity. There will be nothing left over for non-charities like the family, which is good if your investment performance is good. If your investment performance is bad, well, then you're not going to get a benefit from it. But now you're going to have to wind up paying income tax if you're paying an annuity and consists of gross income in excess of what would be $15,600 because that deduction is now going to be cut back under section 68E. That's a very serious issue for many families. And in fact, if you have a testamentary charitable lead trust, which means it won't be a grantor trust, it will be a separate trust, that if you think you're going to have over $15,000 of income, it means you're going to not get your full 642C deduction. That means the trust is going to have to pay income tax on part of its income, and that will cause a tax on tax effect. So one of the things, if you have a client who's been intending to create a testamentary charitable lead trust, which will have to be a non-grantor trust, or if you have even a lifetime charitable lead trust, but you intended it to be a non-grantor trust, you've got to think that through again. And keep in mind, this is effective not just for new trusts. This is effective for all trusts beginning next year, January 1, 2026. It's something that you really need to consider in advising your families which intended to use a charitable lead trust as part of their estate planning.
Jonathan, let me ask you a couple questions. First, just for clarification, you said it's about a 5.5% haircut. This is and correct me if I'm wrong, you or Alan, it's the 2/37ths reduction. Is that correct?
That's right, which comes out to a little bit over 5.4%.
Right. I just wanted to make sure people heard the 2/37ths because if they're wondering where 5.5 came from, that's where it came from. And they'll see the 2/37ths in some of the write-ups. Now, when you said tax on tax, can you explain what that means?
Yeah, I mean, you're going to have a trust which is not going to get the charitable deduction or the full charitable deduction, which means it's going to owe income tax. Well, that means the trust has to pay that income tax. It's not going to get a deduction. It means that every time you make a payment over to charity, your deduction is going to be cut back. And that means you're going to have more taxable income than you originally thought. So it can be very, very gnarly for some situations, and people need to think through what can we do. There's a fairly famous case out there called Lester Crown, which was decided a number of years ago by, I believe, the 7th or 2nd Circuit, in which Lester Crown, who was a great, renowned Chicago business person, went ahead and created a charitable lead trust. And he provided that if the taxable income of the trust exceeded the annuity amount, that they could pay it if the payment ahead of time, the prepayment, would result in the trust reducing its future annuity payments. And that was a very, very clever thing to do, but the court said it wouldn't work. And as a consequence, he wound up paying a lot of tax, which I don't think anybody anticipated he would pay. So you need to think through what are you going to do. If you want to have your client create a charitable lead trust and you think that the income is going to exceed the annuity amount each year, keeping in mind that you're permitted to have the annuity payments increase and decrease through the years. It doesn't have to be a flat $1 million or 5.4% of the original amount in there. But you get a deduction for the gross income paid pursuant to the charitable lead trust for income tax purposes for payments to charity of the annuity amount. But the court said, no, you can't do it in that case because the instrument was construed as not permitting that. So maybe Alan, you or Marty can figure out a way and you can call the Crown family and really be a hero or heroine to them in order to salvage the charitable deduction.
Let me ask either of you a question. So I'm not saying it's not important, and it will change what's been done historically on any non-grantor trust that has charitable beneficiaries. But how material do you think economically to the planning and the decision making and the trust operations the haircut is? I mean, at first blush, it's 2/37 or 5.4. I think you said 5.5% maybe to round. How much impact, what economic impact is that going to have on charitable planning? Can't we just go ahead with the same planning we've been thinking about or the same planning we've done historically and just accept that this is a little bit less beneficial than we had hoped?
Well, Marty, you can assume that. And I guess if you say, well, we wanted this money to go to charity anyway, so the fact that we have to wind up paying some additional tax doesn't really matter, but to some people it really will matter. I mean, one of the beauties of a charitable lead trust, if it's properly set up and administered, is that you don't have to worry about income tax matters for the trust. But now you're going to have to because you're not going to get a full 642C deduction. It's going to be cut back by about 5.5%. And that means that tax is now going to be paid by the charitable lead trust itself, which is going to impact the size of that, which leaves less money there, which makes it more difficult to meet your goal of avoiding tax with a charitable lead trust.
Alan, have you I don't know if estate view has been updated for this new 2/37 haircut, but I'd love to see some number crunching from you in estate view once you can address that, because it'd be very interesting to see, what is I'm Jonathan's comment well taken, but what's the compound effect of that? So if it's for 5 years, because it's a small trust, it may not make. But for 20 years, a lot of these trusts are long term. That's a lot of compounding. Any comments, thoughts, and when are we going to get when can we do calculations?
Is this definitely what they intended, Jonathan? So section 668 is about itemized deductions. So I could see that when I give money to a charitable lead annuity trust, I get an itemized deduction. But are you saying that the section 642 deduction from a trust is an itemized deduction?
Well, Alan, that's a great issue. And as Marty indicated, my co-author, Lad Boyle, who's a professor emeritus at the University of South Carolina Law School, and he's my co-author in the tremendously exciting book published by PLI, Income Taxation of Estates and Trusts. And by the way, if you want to give away a holiday gift, a graduation gift, whatever, give that book. It is just a marvelous, wonderful thing to do.
We always put your book out for July 4th barbecues, Jonathan. It's a hit. It's a real hit.
I want to get a signed one. I don't want just one off the shelf.
I don't know. However, whether or not that was intended, there are some people who say, you know, there was nothing out there about this. It had to be a mistake. They just said, when you broke up, it was intended. The best we can find is that, remember, this bill came into effect very, very quickly. Usually there are months and months, if not a year. When Trump won in 2026, the 2017 Act was not signed until very, very late in December of 2017. And a lot of people had an opportunity to look at it. There were a lot of hearings and stuff, but now there was almost nothing. Remember, this was all done almost immediately after Trump got into office. And I don't think many people saw it. And Ladd was really the first one. He called me, he said, can you believe this? And I said, well, gee, I hadn't even noticed it before. But it may be
Jonathan, do
that
you
you're
think there's a
now,
chance they may change it on technical corrections?
Please.
well, they're supposed to, well, I don't know whether it's a technical corrections or not, Marty, but it will be a political decision, as almost all things are. And whether or not it can come through, I think it's going to be a political decision, not, well, this was an error and so on and so forth. I haven't had anybody say, well, the Treasury has been called and they say, oh, this was a mistake. We didn't mean to take out section 68E, which is the one that says this section doesn't apply to non-grantor trusts and decedents estates. So it's going to complicate planning in a lot of ways. So you have to be very, very careful. You have to think through again what's going to happen. Keep in mind the following. Someone dies, typically there's going to be an income tax-free step up in basis. So you start with an opportunity to maybe change the investments so that you can try to mirror the amount of a taxable income which the estate gets to the amount. The problem now is, even if you can do it perfectly, let's say, Marty, you create a $2 million charitable e-trust. And you say, well, I'm going to have the trust pay an amount equal to 30% of the initial fair market value, which will zero out the taxable portion, the remainder of that trust. And that's all and well and good. And you've run a state view from Allen, and you know how much you should pay. The problem is you're now going to have the trust bearing income tax, and that's going to reduce the amount that's there and reduce the growth or income. One of the things I would suggest that you do if you have one is see whether you can talk to the financial advisors for the client and determine whether or not you can control things so that you're not going to have all of this happen right away. Remember, the lead trust is not typically used in an estate plan to reduce income tax. It's used to reduce wealth transfer tax, typically estate tax. And you can get that benefit even if you are just paying it out to charity. The problem is that the law seems clear that if you're, say you say, oh, we know what to do. We got great financial advisors. We're not going to generate any income. We're going to just have it grow, and the growth will cover the payments, and all of this is terrific. And you run the numbers. Diana Zadel ran some with, I think, JP Morgan, and it looks very, very sweet if your investment performance is good. The problem, and it's a serious problem for wealthy families, is that whenever you pay non-cash assets, even if it's not income, let's say Marty's a $2 million trust, they're paying out 30% of the original value of that. Let's say they're paying $300,000 in a year. Well, Marty, if you're paying that with non-cash assets, the inherent gain in those assets is going to be recognized. So you're now going to have that problem under Section 68E. So it just can't be just wiped away. Well, we're going to do something else. We're going to invest for growth, and we'll pay the growth over to charity from the charitable trust. Even if you can time it perfectly, which I don't think you can, you're still going to have this Section 68E problem. And for many, many families, it's going to be a serious problem.
Jonathan, just to clarify, the reason it's an issue is the 642C deduction only is available from gross income. So unlike an individual taxpayer who can donate an appreciated asset, you have to realize the income. If you realize the income, you're now subject to the cutback on the deduction. Is that what you're suggesting?
That's exactly correct, Marty. And it's a really serious problem. I mean, if again, in this $2 million charitable lead trust you are creating, you're supposed to pay, let's say, 300,000 in a particular year. And even if you have 300,000 of taxable income, you're not going to get a $300,000 income tax deduction under Section 68, under Section 642C. Whether you have, cash income, or whether or not it's through growth and you're paying out those assets. I don't know whether or not you can, if you borrow, let's say, well, what I'm going to do is I'm going to borrow and then I won't have any taxable income. Well, you've got a couple of problems now. One is the possibility of an act of self-dealing under Section 4941 of the Internal Revenue Code. Because sometimes when you have indebtedness and it involves related parties, you have it. In addition, and this is just compounds the problem, you may wind up having unrelated business taxable income, because unrelated business taxable income includes income that's attributable to the sale of an asset which has indebtedness on it. And although normally you think, well, this doesn't apply, we were running a factory, we just held stocks or bonds or whatever, but indebtedness will turn it, or possibly turn it, into unrelated business taxable income. And that means you're going to pay an additional price for that. So this is a very serious problem for families that were planning to do their charitable thing through a charitable lead trust. And in fact, it may make them decide we're going to abandon it all. And part of that abandonment will be that charity will get less.
Alan made an interesting comment that we didn't really get to. Alan, maybe you can expand on it, and I'm curious to hear what Jonathan's view. If we have Section 68 by 237ths, a reduction in itemized deductions, that really assuredly apply to the trust income tax deduction for charity. Didn't you have some thoughts on that?
First of all, I guess I don't know much about this, but let's point out that this starts to apply in 2026.
That's a good point.
You're going to do a large
Plan
charitable
now.
annuity trust. Maybe it's more important to do it now so you get the full income tax deduction. But secondly, Section 68 had a problem. Nobody knew about it, but it says an individual doesn't have these deductions. The individual has a cutback, and it doesn't apply to trusts or estates. Well, trusts and estates are not individuals under the Internal Revenue Code. The word individual under the Internal Revenue Code is not defined, but there is case law that says that an individual is not the same definition as a person. Under the Section 7701 definition of a person, any entity can be a person. But there is case law that says that an individual is not an entity other than an individual. So you can argue that Section 68's reference to trusts and estates was just a mistake. It wasn't necessary. It was surplus language. So it'll be interesting to see, with this strong charitable lobby in our country, what happens between now and January 1st, 2026, when this lunacy would begin to take place.
Jonathan,
I won't have to update my software until then, by the way.
that was the question too.
Well, keep in mind that Alan is correct that the Internal Revenue Code itself does not say, give us a definition of individual. I mean, there are other provisions in the United States Code where individual means a human being. But keep in mind that Section 641 says, for purposes of determining the taxable income of an estate or trust, that estate or trust is treated as an individual.
Right.
And, for example, if you take a look at Section 642C, it says, in lieu of the deduction under 170, which is the section that individuals get their charitable deduction for, it says, in lieu of that, we're going to give you the deduction here under Section 642C. So yes, I hope that people will be able to convince the Treasury either to come out and say, no, it doesn't apply. It's not an itemized deduction for an estate or trust. Or perhaps it will be changed because it's good to promote charitable things. But I am very concerned that if the Treasury wants the money, and it may, of course, it will perhaps turn on Trump and his predilections, it will be that you are going to have this haircut of 2/37 or about 5.5% of what otherwise would be deductible. And again, that means the trust has to pay it. So there's less money in the trust. Less money in the trust means that you're going to pay more income tax on the trust. Remember, the trust is not going to be income tax exempt. At least if you do an inter vivos charitable lead trust, everything is going to be attributed to the grantor, where the charitable deduction, which would be obtained perhaps when the trust is set up or annually as payments are made, is going to be under 170. And if you're a married person, you're not going to face the cutback under Section 68 until you're about over 750,000 of income, which for most people is, very, very high. But for an estate or a trust, it's at about $15,600. And so it's going to have a really serious impact on this. Also, keep in mind, if you say, well, what I'm going to do is I'm going to use an inter vivos charitable lead trust. And, I don't have to worry about it because it's going to be a grantor trust. And I don't have to worry about the cutback under Section 68 for an estate or a trust because it's not an estate or a non-grantor trust. But the problem is your client will die and grantor trust will be turned off. Now, maybe you want to put in that, well, the trust will end on the first to occur of X number of years, or when the grantor dies. That's something else, and that's something people will have to think through. And maybe Alan and Marty, people will say, well, I'll get a policy of insurance. So if the client whose life is measuring the term of the charitable lead trust to provide that when that individual dies, it will no longer be a charitable lead trust. That in turn will have an impact, and it would prevent you from zeroing out the taxable portion of a charitable lead trust.
But for some people, for a lot of people, given the current high exemption, if it remains permanent, that's, we'll see. They may be okay using some exemption on this. Jonathan, let me ask you a question that, maybe you've already said it, but I just want to clarify, and it ties back to what Alan said about, what is an individual? Is a trust an individual? If a trust is not an individual, as Alan suggests that case law says, but isn't the whole framework, and this may be what you just said, and I may just be saying it slightly differently, isn't the framework of the code that a trust is taxed as an individual except as otherwise provided, so that unless it's otherwise provided, you have the same taxation structure as an individual, which would mean the 68 reduction of 2/37. Am I saying that wrong, or is that?
No, that's exactly correct. Because remember, when you take a look at Section 642C, it says in lieu of the deduction under 170, which is where individuals get their income tax deduction, an estate or a grantor, a non-grantor trust will get its deduction here under Section 642C. Now, there are differences on whether it's a decedent's estate or a trust, and we don't have to go into those, but there are some differences between whether you're a non-grantor trust or a decedent's estate. But you're absolutely correct, Marty. You take a look at the code, and it says, for example, Marty, I know you've tried this because you have a lot of children and grandchildren. You think, well, what I'm going to do, my income this year is going to be $5 million. And most of that is going to be subject to tax once we get to 750,000 of income. So what I'm going to do is to give part of my income to my kids and grandkids and keep it all below that top, or most of it below that 37% bracket. And Marty, that's terrific. Of course, if you do that, you're going to go to jail because that's tax fraud. You can't take your income and give it to someone else and say, hey, you go ahead and pay the tax or report the income. You can't do that unless you're an estate or a trust where you can go ahead and get a distribution deduction under 651 or 661 and shift that income over to someone else. And that's that's probably the major distinction between the taxation of an individual on the one side or an estate or a non-grantor trust on the other. But keep in mind that one of the other big exceptions to that rule that Section 641 says the income of an estate or a trust will be determined as it is for an individual is for the charitable deduction under Section 642C, which says in lieu of the deduction under 170, which is where an individual gets his or her income tax deduction, you get your deduction if you're a non-grantor trust or a decedent's estate here under Section 642C. Now, by the way, I'm not going to get into it, but keep in mind, you can be thrown back into Section 170 if you have unrelated business income. And one of the things that I haven't thought through, Alan, is whether or not there's some way to me to generate that kind of income. So I'm not going to take the deduction under Section 642C, but I'll be thrown back under 170. And does that mean that I don't have to worry about the cutback? I don't think it works, but I just thought about that this morning for the first time.
It's really brilliant.
Why wouldn't 170 be subject to the same cutback?
Well, it's because an individual, you don't hit it until you're at 750,000 of income.
By application of it.
Yes, by application of it.
Forgive me, but I'm obviously slower than you and Alan. Let me ask a question that you probably have answered twice, but I'm just a little befuddled here. If Alan is correct and an individual is not deemed a trust under case law, but because the code defines taxation of trust to be the same as an individual except as modified, even if Alan is correct, would that then still have an impact, or would that have no impact because it doesn't matter because the code is saying a trust is taxed like an individual, even if it's not an individual?
It says the taxable income of an estate or a non-grantor trust is determined as though it were an individual.
So even if a trust is not an individual, as Alan suggests case law says, it shouldn't matter because we still have the way the paradigm, their approach that the code takes to taxing a trust is to say you're taxed like an individual. So even if you're not an individual, the cutback still applies. Alan,
That's
any
correct.
thoughts on that?
I can see the argument. I argument.
I don't know, Marty. Unlike you guys, I sometimes get confused about the law. And I don't think things happen the way they were intended, or they mean something other than what the words are. Remember, words are an imperfect means of communication. And every time you have a proposition stated in words, you say, this is clear. Well, maybe it's not so clear. And courts tend to do a lot of things that way. So you have to be very, very cautious.
You know what's remarkable? Just forgive me for on a tangent for a second. The OBBA, the One Big Beautiful Bill Act, is almost 1,000 pages. I think it was 940 or 960 pages. And we've just spent all this time talking about a line and a half that was omitted, and we're not even sure if it was intentionally omitted. Right?
Yes, that is correct.
When you think, if you extrapolate from what we've been talking about, just 68E, and we're not done yet. I want to bring up a different example that's simpler. The scope of the complexity of what this law has created is really monumental, and practitioners really are going to have to grapple with it. Ponder that. It's almost 1,000 pages. We've talked about a sentence and a half, one sentence, line and a half. Let me change gears a little.
Marty, let me interrupt if I may. If you take a look at 641B, as in Bravo, and this is under the title Computation and Payment, it says the taxable income of an estate or trust shall be computed in the same manner as in the case of an individual, except as provided in this part. The tax shall be computed on such taxable income and shall be paid by the fiduciary. Now, there's a special rule for purposes of this subsection. It says a foreign trust or foreign estate shall be treated as a non-resident individual who is not present in the United States at the time. So basically, again, the taxable income of an estate or a trust shall be computed as the same manner as an individual, except as otherwise provided in this part. And, I just don't see that you can say, well, we don't have to worry about this because we used to have this exception under section 68E. I am very, very concerned that if you just put this into Chat GPT and it didn't put any thought in it, it just took a look at the words, you're going to have section 68E apply.
Are you suggesting that our clients won't get all the right answers in AI?
Yeah.
How silly of you. Let me change gears a little bit. One of the things that we and others have talked about post OBBA is the idea of saying to a more moderate wealth, and moderate is still very high, client taxpayer, hey, you're not going to qualify for an itemized for itemizing deductions, and many taxpayers won't. I mean, the vast majority of taxpayers won't, and I think even a material number of clients that hire professional advisors won't qualify to itemize.
Well,
So,
Marty, let me mention that if you're in a high tax state, as you and I are, but Alan isn't. Alan's in Florida, which has no state income tax. And, they also have low taxes on your homestead. So that's a pretty big deal because the big thing that people lost under the 2017 Act was it lost the
SALT.
deduction for state and local taxes, like your real estate taxes or your income taxes. And now, because it's been increased to $40,000, not $10,000 anymore, which was the limit that came out of the 2017 Act, there will be many more people who are eligible. But once you get into that top bracket, you get cut back. I can't remember, Alan, exactly what it is, but I think if you're above 500,000, and by the time you get to 600,000,
it's gone.
Modified adjusted gross income, hey, you've lost the benefit of this increase in the so-called SALT deduction. So you may have a lot more people. I think you'll have many, many more people who are eligible to and probably should consider itemizing. But for, wealthy guys, Marty, like you, who live in high tax jurisdictions, you're not going to get any benefit of it.
We're going to do another program on SALT planning, I think. But let's stay with the charity for a second. You're correct. The number of people that itemize because of the change in the SALT deduction may increase as compared to the number that itemized after the 2017 Act. But I think the number after the 2017 Act may have been 9 or 10%. So maybe it's 12% or 15%. So all advisors are going to have a large number of clients. Most advisors, maybe not those that focus only on the very high end, are going to have a lot of clients that aren't going to itemize. So what I wanted to suggest, we've all talked about, and others have written and talked about post OBBA, creating a non-grantor trust. So if nothing else, let's say I put, and even for a very small client, let's say I put $250,000 into a trust and it makes 5% a year and I pay 10 grand to charity. That $10,000 charitable deduction, I may not get to itemize on my personal return because for a married filing joint, it's $31,500 of standard deduction. So I would lose the charitable deduction and leave aside the $1,000, $2,000 above the line deduction. But I could create a simple non-grantor trust, name my brother as a trustee, do it in my home state, keep the cost down, keep it simple, put $250,000 in, let the trust pay the charity, and in effect, not only get my standard deduction, but I've effectively gotten a charitable contribution deduction, except for the haircut, to offset the income the trust earns. And I could do that as a non-grantor slant, so my wife and all my descendants could be beneficiaries. So if I need to get money to family or there's more income than the charity than we want the charity to get, I can make distributions to the family. That still seems to be a really effective planning tool for some category of people, I think a meaningful number of people. Only in the beginning, when it was being talked about, people hadn't yet realized about the 68E repeal, so that now you have this 2/37 reduction in that. But on 10 to 15 grand of income, whatever a trust of that small size is earning, it's not a large haircut. It is a haircut. It'll have an impact. But how do you evaluate planning for these smaller, more moderate wealth clients, moderate income clients that are still salvaging a charitable deduction? Because I think that's still good planning, yet it's not going to be as beneficial with the reduction. Alan, comments, thoughts?
Marty, I think that's a very, very good point you've made, Marty. And keep in mind that although we have section 643F, which says that if you have more than one trust, which is not a grantor trust, it will be treated as one trust. All those trusts will be treated as one. So you face that limitation basically at $15,600 if the multiple trust rule applies. And section 643F says more than one trust will be treated as one trust if you have the same grantor, and husbands and wives are treated as one for this purpose. And you go ahead and you take, and you have the same beneficiary or beneficiaries. However, if what you did, Marty, you created, let's say, 5 trusts, you have one, your spouse has one, remember you're going to be treated as one. But if you have 5 descendants, you have 3 children, let's say, and 2 grandchildren, you now should not have the multiple trust rule apply, so that you can now do more than you originally thought you could do. So that's very important to think about. Now, the people who are really going to be in the thick of things on this, I think, are the CPAs, who are going to, run numbers for everyone and try to do the best job they can. But you need to see your CPA about it, and you need to see your CPA before the end of this year. I want to make one more point. Once you get above 70 and a half years old, you have another option, which is a very good one. You can give away $108,000 a year from an IRA to charity. You pick your charity. I mean, you can't give it to your private foundation, but you can give it to most charities that you would support and be able to get the full benefit of the deduction, because you don't take that amount paid from the IRA over to charity in your own gross income. And yet it will satisfy, in most cases, the minimum distribution requirements from IRAs. So that's something that you really need to think about. And you really want to think about, where should we pay our charitable contributions from? And you can do 108,000 per taxpayer.
That's a great point. I want to come back to that because there's a bigger theme of what OBBA has done to charitable planning that I want to emphasize. But Alan, can you talk for a couple minutes about the planning I suggested for more moderate wealth taxpayers? Because I still think that it could be a pretty cost-effective way for more moderate wealth taxpayers to get a free deduction if they're not itemizing. And as Jonathan said, those in large high tax states, it may not work for, but that still leaves a large universe of clients.
You're talking about using the non-grantor trust?
Yeah, for charitable contributions for those that don't itemize, despite the 2/37 haircut.
Right, right. I could see a charity, instead of drafting charitable remainder trusts for free, drafting charitable slants for free.
Yes.
Come
Now,
to our charity.
what do you mean by a slant, Alan? Tell us what that magical term that you and Marty have been using, just for the many of us out here who don't know what a slant is.
Oh, if you define it, Alan, it won't have any mystery or appeal.
Well, it's a spousal limited access trust. It's a trust that I formed for my wife, Marcia, and our descendants, but it's a non-grantor trust. So it's a spousal limited access
Lifetime.
non-grantor trust, a slant. So should my charity, which has hundreds and hundreds of donors, go ahead and offer a prototype slant, where the charity will serve as trustee at no charge. Charity will receive taxable bonds from the client. The charity will pay the income from the bonds to the charity until the client terminates the charity as trustee and moves it to the spouse or some family member. So then there's almost no administration cost. The charity can agree to do the 1041, and the client just has given away a tree has rented a tree and rented the fruit. That is an assignment of income that should work. It's legitimate. When I'm tired, if I get upset with the charity, then I replace them with another charity or distribute those bonds out to my children as they need it. So it's a nice
But
to put.
you can't do that, but the trustee can do it, because the one thing you don't want is for that trust to be a grantor trust. And normally under section 677, if you create a trust from which your spouse or you can benefit, it is going to be a grantor trust. Now, the exception under section 677 is that if the distribution to you or your spouse is controlled by a, quote, non-adverse part, by an adverse party, someone who would be harmed by that distribution to you or to your spouse, it's not a grantor trust. However, when you look at the case law on it, it may be somewhat difficult to find those adverse parties. Like you might think, well, I'll do a trust for my wife, and I will need the consent of my oldest child, who's a presumptive remainderment of the trust. I will need his or her consent to do that. That makes the child an adverse party, and therefore it's not a grantor trust. But when you go down into the case law, you find that the courts have said, we know what the words say, and we know on the face of it, it's an adverse party and therefore not a grantor trust. But the courts have said, look, if in the real world, we know that the child is going to do whatever daddy wants because the child doesn't want to upset daddy, they may not find the child to be an adverse party.
It still seems to me, and we're changing gears now from where we were on the charitable lead trusts, but it seems to me that this concept is really viable. It's got a lot of flexibility. If I set up a trust and my spouse and all my descendants are beneficiaries, I name my example earlier, my brother is a trustee. He's not going to charge a trustee fee. I put in whatever my wealth advisor tells me is necessary to generate the 10 grand a year we want to give to charity, or 20 grand, whatever number I tell them. There's a really effective tool for a large number of people to inexpensively and without great complication salvage a nice deduction. And in fact, I think that the wealth advisors should be jumping all over this, because they can go to clients, they have their tax returns, they know what their budgets are, say, hey, you're giving 15 grand a year to charity, you're getting no deduction because you don't itemize. Why don't you set up a non-grantor trust, and you can give it to your kid, the money, the trustee can give it to your kids or your spouse or grandkids for that matter, because no one's going to care about GST at this level of wealth with this kind of high exemption. And you're going to, in effect, get this income tax free because you'll pay your charity out of the trust. I think this is a slam dunk. The only caveat on it, apropos and to tie back to our earlier discussion, is you're going to have this 237th haircut. But, you know, if you're talking about 10 grand, 15 grand a year of deductions, because for people that are not going to itemize, it's probably not going to be a lot higher. I don't think, you know, 5.5% at 10 grand is going to make a difference in the planning. Alan?
Psychologically, they're going to feel like that's coming out of the charity share, not theirs. I'll put my
And they got a deduction. They got income tax free.
Yeah, I'll put my $500,000 worth of bonds in this temporary trust. You're going to thank me profusely and handle it for me as the charity. And I'm not going to have to pay income tax on the income of those bonds. Do I really care that the charity's going to get 2% less? Maybe
No,
not much.
no. And because your spouse, except I've spoken to Marcia, you cannot limit her access. But
Right.
I can't either. But because the spouse and all descendants are beneficiaries, you're also not going to feel bad about the back end, because, hey, if things change in the future, my feelings change in the future, then I'll get the money to the family. So
I'll
what?
change trustees and get the money to the family.
Right.
I don't
I
think
think
it's
it's a great.
Yeah, I don't think it's any coincidence that 2/37 times 37% is exactly 2%. It's a 2% haircut, but 2% is not, not something that's going to change a donor's mind, I don't think.
No, because
We,
they got a found deduction where they wouldn't have had one before.
right, right.
I think this is different than the impact on a large dollar value charitable lead trust that is going to go on for decades. So to me, this is a different kind of planning.
Right. And by the way, if you go ahead and give a small annual management fee to your son-in-law for managing the trust, that may zero out the tax.
How does that, how so? I'm not,
It would be a tax deductible expense. It would exceed the 2%. But I'm just thinking out loud, there may be deductible fees by the time you pay the accounting fee.
which
And you,
shouldn't be a lot. This is a pretty simple trust.
yeah, yeah,
And honestly, if you're giving a big chunk of the income to charity, people may just do this with an online tax service. I mean, there's not a lot. I don't see this as particularly complicated. You're getting bond income or dividend income. There's a charitable contribution deduction, and maybe there's a D&I distribution to family that takes some income out of family if you give some to family. And in many years, it may just all be charity because you're going to plan the dollars you put in the assets to sort of coordinate with the charitable deduction
yeah,
because that's really the goal. I think wealth advisors will love it because they can say to their clients, listen, you're giving X dollars a year to charity. You can't itemize. You're paying income tax on that. You're getting no deduction. Flip it into a non-grantor trust. We just move it to a different account here. You get a fairly simple local trust document, the family member trustee, and bam, you got a tax-free chunk of your portfolio.
yeah.
Let me step back and make a sort of a broad statement, and maybe you can elaborate. This again points out to me one of the concerns I have with post-OBBA planning. We talked about the impact of the haircut and charitable planning on large dollar charitable lead trusts. We talked about using this simplified slant, spousal, you call it limited access, I called it lifetime access. What doesn't matter what the words are, they're not magic. Non-grantor trust. And there's variations. In 2017, Jonathan and I wrote some articles calling it salty slats because we were doing it for the SALT deduction. And we need to do something on that planning as another program in 199A, but that's not today. But look at the complexity. So is the client in a high tax state such that they're going to be able to itemize, but is their income? So that's another category. Tax in a low tax state, so they can't itemize, and they should do the planning we just talked about with a non-grantor slant. And you don't have to be married. You could do it with just a non-grantor trust. But then you have clients in a high tax state that because of their income level, they're going to get no SALT deduction because it's going to phase out after 600 grand of income back to 10 grand. And they may not be able to itemize even though they're paying a boatload of local tax and have high income. So one of the things that is worrisome is look at all the little buckets we have of different clients. I think more than after many other tax bills, because of the complexity and the odd interactions and very different tax structure, we will probably see more variation in planning for each of our pools of clients than I think we've ever seen. You got to be very careful saying I got a slat. Up until now, we were all using slat to save exemption, but now planning is much more granular and much different per client. Like I said earlier in our program, that we may have some very wealthy clients that have very little tax once the QOZ kicks in and they got their 199A has been enhanced, or the bonus depreciation and the write-offs of R&D. We're going to have some clients, maybe not a lot, but some that may not pay much tax. So it just seems like we have more variation and planning is going to be more complicated. That's the plug for you to say that's why you need software, but go ahead, comment. I'm concerned about the complexity.
I agree, but we've always had to be nimble, and you always have to call in this. You always need to call in the CPA and the financial advisor and the lawyer and the other lawyer, and then even a third lawyer, and hope we get it all right. But that's what makes it all very interesting and gives us a lot of opportunities to improve what we see.
I think that's really important, given the complexity. I think, and I'm going to sound like an advertisement for NAPEC, but it's a team sport. The complexity and the interactions of this law make it more important, I think, than maybe ever that the estate planner, the accountant, the wealth advisor, and the insurance consultant, like we talked about some tie-ins with insurance, all get involved. And let me throw something else in that's almost always ignored. People don't bring in advisors, don't bring in the charitable gift officer. That's a terrible mistake. You and I, no matter how much we know about charitable planning, we don't know what applications any particular charity can do with the money that a client is giving them. And a lot of clients are very interested in having some input in designing a charitable gift plan where the money is going for causes dear to them. So we should involve the charitable gift officer because they can really get the client juiced by helping show what they can do with it, right?
Absolutely.
Alan, do you want to wrap up, make some general comments? I'm kind of amazed that we spent an entire program on mostly 60/80 and the impact of OBBA on just non-grantor charitable planning, but we did.
I'll say a person's a person, no matter how small, but a trust may not be an individual, so its 642C deduction may not fall.
Oh my gosh. And in case people didn't know what a poet you were, they thought you were just a smart tax attorney. Now they know you're a gifted poet.
But upon 681, we may be hung.
All right. I can't possibly say anything after that. Thank you, Alan, for your poetic ending and summary, and thank you all for joining us. Take care.
Bye.